Thanks for joining us, members of ShareSoc. Delighted to be doing this. This is something that we've been very keen to work with ShareSoc on, and given it's our first, any feedback in terms of how we iterate future versions would be welcomed by us, and particularly if you've got areas that you want to hear more from us, would love to hear about that too. Edison, hopefully you all know Edison, but if you don't, we've been going about 20 years. We are an issuer-sponsored research firm, but do much more than that in terms of we organise roadshows, webinars, and really the principle of what we're trying to do is bring institutional quality research to the widest possible audience. It's a democratization of information drive, and hence very supportive of societies like ShareSoc. I would love to be able to get you to know our analysts, and one of the reasons we're keen to do these kind of webinars is I think it'll give you a better flavor of the team that we have here and the kind of people that you may be able to access. And so I just wanted to introduce Milosz Papst first. Milosz, if you want to just introduce yourself, your sector, and the coverage you look at.
Yes, of course. Thanks for having me. I'm Edison's Director of Content, responsible for managing and shaping our content on investment companies. I've been with Edison for more than 7 years now, prior to which I was part of the equity research team at Crystal, which is an S&P global company. And I've also worked for a boutique US research provider focused on emerging market equities. In terms of our investment companies team at Edison, we have 7 analysts, most of whom are seasoned and been working with Edison for more than 5 years. Some of them have been with us for more than 10 years. And collectively, we cover around 60 investment companies.
Thanks, Milosz. And bringing in the healthcare expertise and perhaps also a flavor of the international dimension of Edison, I'd like to introduce Neil Maruka. Neil, if you want to introduce yourself.
Thanks, Neil. Yeah, I've been part of the Edison team for only a few months now, but very excited to join an exciting organization like this. I was a senior equity research analyst at a large international independent brokerage for 12 years, based out of Canada. Have covered everything from biotech to medical devices to specialty pharma, and very excited to bring my background and experience to Edison.
Okay, and hopefully all of you have been sent a copy of the report or have access to the report we're talking about. If not, I mean, we get in touch and we'll make sure you get a copy. Before actually getting into the findings of the report, and the slide there I think summarizes the key findings, I just want to provide a little bit of context for the audience. And you know, we have on the one hand someone who's focusing on investment companies, on the other hand someone who's focused on the healthcare sector and listed companies in the healthcare sector. Would love both of you just to provide a compare and contrast of the performance of the respective areas over the last sort of 3 years, and then perhaps more recently over the sort of 12 months, particularly as we've seen, you know, that period where interest rates were driving up, and then, you know, probably more recently that's been peaking, and the response to the sector's that. Milosz, maybe I could start with you. Well, actually, no, Neil, given that we're talking about the healthcare sector, Neil, maybe it's better you provide the context of the healthcare because one is derived from the other.
Sure. Thanks, Neil. Yeah, for since the start of COVID, from March 2020 to February 2021, the S&P Biotech ETF, or the XBI, has been up about 250%. One of the key drivers there are zero interest rates and really unprecedented liquidity that we've seen in the market. That drove valuations to untenable levels. From February 2021 to November 2023, the XBI was down 65%. Since then, the S&P Biotech has been up 62%, and really that's on anticipated lower interest rates, expectations of M&A with pharma patent cliffs looming, and really market excitement on the back of the Trump trade. Over the past 12 months, the XBI has outperformed both the broader S&P Healthcare Index and the S&P 500. But more recently, what we've seen is that the life science sector is down 5.7% on profit taking, and tempered excitement following the announcement that RFK Jr. was nominated for the head of Health and Human Services, or HHS. Some of the stocks that have been most impacted by that have been vaccine and obesity stocks. Those are because of some negative comments that RFK has made in the past on that. But what we've seen ultimately is that the XBI and the NBI, the NASDAQ Biotech Index, remains substantially below their 2021 peaks. What I would say, if you look at, outside of biotech and you're looking at pharmaceuticals, investor sentiment is at record lows for pharmaceutical companies. Pfizer, Bristol Myers, Merck, J&J, their PE ratios are at really cyclical lows. The only stocks that are really outperforming and where you're seeing historically high PE ratios is Novo Nordisk and Lilly. And what's the common theme there? Really, the obesity stocks, the diabetes stocks, where we're seeing some really hot activity.
Okay, that's great. And Milosz, maybe given that you're focused on the investment companies that are investing in the sector, perhaps run through something similar, just so we understand the volatility, whether we see the same levels of volatility in the sector or not.
Yes, sure. Thanks. Of course. Yes, and Neil, thanks for providing the context from the broader sector. Now, actually, the performance of healthcare-focused investment companies has been quite dispersed. Let's put it that way. Which is a function of diverse range of investment remits of those investment companies, right? Because on one hand, we have those which hold more diversified portfolios across the broader healthcare sector, so covering the big pharma, biotech, healthcare IT, medical devices, healthcare services, etc., such as Polar Capital, Global Healthcare, or the World Healthcare Trusts, right? Then we have some investment companies which focus specifically on the biotech sector, but invest across the market caps. And they at times they tend to have a greater bias towards the large mega caps, and at times to the smaller emerging names. And then we also have a number of investment companies which actually focus on the smaller emerging names. In some instances, they even focus on pre-commercial stage companies. So, of course, this investment remit determined the performance over recent years, given that we've seen a divergence in performance of the broader healthcare sector compared to the biotech sector, and more specifically the small biotechs. What is also important to look at when examining the performance of those trusts is what's the percentage of companies which are already commercial stage compared to the clinical stage. Of course, it's in many cases the function of the market cap, but not always. Some of the small cap names may already have may already market products, whilst others will be still in the clinical development phase, right? So the greater the exposure to the smaller emerging markets, smaller emerging biotech companies, which are long duration assets, the greater the impact of the rising interest rate environment over the last 3 years, basically, right? And also the partial rebound we've seen over the last 12 months, because as the interest rate environment stabilized a little bit, and we've seen some indications of a potential turn in the interest rate cycle towards the end of last year, we've also seen a partial re-rating of the smaller biotechs. So the performance of healthcare-focused investment companies will be dependent on their exposure to those respective market segments. But on top of this, of course, the stock selection will play an important role. Virtually all of those investment companies have high conviction portfolios which have a lower number of constituents than the broader indices, right? So the NASDAQ Biotech Index or the MSCI World Healthcare Index, for instance, they have more than 200 constituents. Whereas when you look at the investment companies, most of them tend to have portfolios between 20 and 70 companies, roughly. So, of course, stock selection is also critical. And again, changes in terms of moving across the market cap spectrum. Some of them just focus on the smaller end of the biotech space, whereas others will have a more active approach in terms of overweighting certain market cap segments, which will also determine the results. And then finally, it's also important to highlight that some of the investment companies have a quite significant share of private investments, which of course determines the short-term volatility in their NAV, right? And then finally, we need to look at performance of healthcare-focused investment companies from the NAV total return perspective, but also the share price total return perspective, right? Given that we've seen a widening of the discounts compared to historical averages, which had an impact on the share price total return versus the NAV total return.
Okay, no, Milosz, thanks very much. And Neil, I want to sort of lift back up to sort of a higher level of to try and understand actually what is driving the trends in the healthcare sector. And I think you started touching on some of those things in terms of rates, etc. But what are the key trends driving healthcare, particularly in the small and mid-cap biotechs? And then Milosz, maybe I can bring you in to add to that from what you're seeing from the investment companies side.
Sure. As for many sectors, macro is going to be key here. Interest rates, Milosz touched on that a little bit, but with lower interest rates, you have lower discount rates on valuations, which result in higher valuation, a lower risk premia, which means that investors are more tolerant to risk and more likely to get into and invest in these smaller biotechs, which obviously come with higher risk profiles. There's going to be increased spending in the economy in general. There's going to be increased M&A activity with lower financing costs and discount rates and lower discount rates and risk tolerances on longer duration assets. I think that's going to be probably the key here, and that's going to dovetail into what's going on with the Trump administration and RFK. We'll talk about that in more detail later, but I think generally that it will be very positive for the business environment. Fund flows is critical. I think that's something that a lot of portfolio managers who pay attention to the space focus on. Biotech venture financing remains strong and is improved on a slower 2023. That means that those early stage companies are getting financed. Biopharma private debt markets are very robust, and we're near a record year in private debt issuances for life sciences. And then finally, as I touched on before, M&A is going to be very important here going forward in our view, and we highlight a lot of this in the report. M&A volumes were very muted in 2024, but that is expected to change with lower interest rates. There's a lot of pent-up demand out there. Pharma is ultimately it can't innovate and is not very productive with their R&D dollars. So that's going to be a major driver and a major factor and that's a key form of liquidity for investors in biotech stocks.
Okay, so liquidity and M&A, I think, is the sort of big takeaways on that. And of course, the political environment that we find ourselves in. Milosz, anything else you are observing from the investment company side?
Yes, maybe what I can add to that is, well, Neil obviously discussed the immediate catalyst for the changes in valuations and the investor sentiment, right, towards more long duration assets, right? And what we will probably do during this webinar, we also put it in the context of the longer term fundamentals, that the patent cliffs which the big pharma is facing, probably the fact that the sector has over the years has become more fragmented, right? If you look back 15, 20 years ago, most of the approved drugs were developed in-house by big pharma, right? But at some stage, this has changed, and the contribution of those smaller biotech companies to the innovation pipeline has grown. And this is also what drives the M&A, right? The fact that the big pharma companies are not developing most of their drugs internally, but they seek M&A or licensing deals to replenish their pipeline ahead of the major patent cliffs, right? So this is probably something worth mentioning. And then the fact that we had this significant drawdown in recent years also probably led to a certain level of right sizing of the sector, if we can put it that way, right? Because back in 2020, 2021, we've seen a spike in IPOs of companies which were probably not mature enough to be listed. So we've seen some weeding out, and this, I would say that probably this led us to an improved situation in terms of the fundamentals, right, and the opportunity set in the sector.
Okay, and Neil, you mentioned that it was the obesity plays that were attracting a lot of market attention. But I mean, if you historically, when we've looked at where are dollars invested in therapy areas, oncology for many years has been sort of top of the pile. Then there's always other things that sort of come in and out of that. So CNS some years, femtech in other years, etc., has been sort of moving up the curve. Be interested to hear from you. What are the sort of most promising therapeutic areas and areas of innovation that are driving the healthcare sector?
Well, you're absolutely right. I mean, oncology is always the major focus. It's the largest segment, representing 20% by market share. It's the fastest growing segment by sales, and it actually represents 50% of the biopharma deal volume. If we're looking at FDA approvals and over the in 2023 in particular, hematology 16.1%, oncology also 16.1%, and neurology, another segment that you touched upon there, at the same percentage. So those are the three largest segments that you're seeing where the FDA is focused, and you're seeing a lot of innovation. So it's obviously been attracting dollars over the last while. Diabetes and obesity, that remains hot with Ozempic and Wegovy being used off label in obesity. The multi-billion-dollar opportunities, and as I mentioned previously, has driven the valuations for these companies to historical levels. And I mean that the high PE is really forward looking, right? So there's more potential there as well. Novo Nordisk and Eli Lilly, they remain the darlings of pharma. The focus has been in the past on GLP-1 agonists, that's Ozempic and Wegovy, but we're also seeing hot areas of research in amylin, which is another pancreatic hormone, and there's lots of excitement around a product called CagriSema, which is the next generation obesity drug from Novo Nordisk. Neurology and specifically Alzheimer's presents some. There's donanemab from Eli Lilly, which targets amyloid, and Leqembi from Eisai and Biogen, which also is a monoclonal antibody that attacks amyloid. When we look at some of the early stage areas where that's attracting dollars, the deals have been in particular in antibody drug conjugates. That's when an antibody, which is very focused, is attached to a drug and targets that drug to a specific receptor. Multi-specific antibodies, meaning antibodies that can target two different receptors, cell therapy, and also standard biologics. So biologics, these novel fit therapies, cell therapies, which the CAR T, which is a cancer vaccine, very hot areas, and I think that those are the ones that will be up and coming and have been focus of early stage deals as of late.
Okay, and then I mean, I guess all of these developments have to go through an approval process, and I'd be curious, Milosz, from your perspective, how you're seeing the impact of FDA drug approvals on the sector's growth and investor sentiment, because you have been talking to a number of fund managers investing in this space, so it must come up.
Yes, absolutely. I think that the high number of FDA approvals in recent years is, first of all, a good indication of the level of innovation within the industry. Last year was actually a record year with 67 drug approvals. And overall, in recent years, except maybe for 2022, where we saw a slight dip, which may be related to kind of a slowdown in patient recruitment for clinical trials during the COVID pandemic, right? I would assume. We've seen approvals north of 50 drugs per year. Just to put it into context, if you look back at 2006, 2010, the FDA approved on average around 20 to 25 drugs, right? So now we have twice the number of drug approvals. And what is probably also worth mentioning is that slightly more than a third of the chemical-based drugs last year approved by the FDA were so-called first-in-class drugs, which means that they have a novel mechanism which hasn't been available in the market before based on already approved drugs. So this is probably also worth mentioning. I assume that the flexibility of the FDA in terms of approving drugs has been a contributor to the growth in the sector. For instance, with the fast track process, right, for certain drugs which address certain unmet needs for series of life-threatening diseases, right? So orphan drugs, etc., which first of all includes more frequent communication with the FDA to streamline the development process. Secondly, it also allows to submit documentation for approval in batches, right, rather than the full set of documents, right, within the application. And then finally, you also get like kind of a fast track review process, priority review of 6 months compared to the average 10 months. Because there is also some criticism recently in terms of the pace of approvals for drugs from the FDA, and maybe also some questioning of the exclusivity period for orphan drugs, right, and how it impacts the cost of treatment. But other than that, I think the level of FDA approvals in recent years is a good illustration of the dynamism and the innovation within the sector.
Yeah, I mean, with these things, you get a drug approved, there's a significant valuation crystallization point there, and so if you've doubled the opportunity set over the last 15 years, clearly it's interesting for the sector. There was a question that came in, and I think it sort of follows neatly on from that, which is that how do you see this, Neil? I mean, you're on the ground. How do you see this changing with the Trump win and Trump's nomination of RFK as the lead for the Department of Health and Human Services?
Always an interesting question, something that's on the top of everyone's mind. Generally, these trades are very transient as they reflect uncertainty as to what's going on. I would question how much one person could really do within any of these indications, within these institutions. I think that there's a lot of questions around whether RFK will actually successfully get the nomination. Nonetheless, I expect that there's going to be some pressure within the FDA to create higher hurdles on drug development. Vivek Ramaswamy has also taken very keen interest in FDA policy and could promote a pro-business, pro-innovation stance. Thinking more broadly about Trump, he did promise to lower drug prices in 2016, but he didn't follow through. And more recently, he's been very supportive of gutting some of the drug price control provisions in the Inflation Reduction Act, which should be very positive for biopharma. That's very in line with what the pharma lobby is looking to do. So I think that that's going to be very pro-business. And finally, I would point out that two prominent investors, Bill Ackman and Yair Einhorn, see Trump policies as promoting M&A in biopharma. So I think that kind of dovetail very nicely into our thoughts as well.
Okay, so I'm reading that as actually you're reasonably benign about the outlook, despite the noise around this.
I think there's a lot of noise around RFK Jr. But I think if you kind of look at what Trump's policies are and what he's stated as of late, I think that he's going to be very positive on drug pricing and very pro-business oriented.
Okay, and so taking that, and that sort of outlook effectively for 2025? I mean, what do you see as the challenges and opportunities for particularly small and mid-cap biotechs?
Cash is always number one. So small caps are going to struggle to attract capital. So as I mentioned in my earlier comments, fund flows are critical. Venture funding has been stronger as of late, and we're always keen to see how the IPO window is going to impact. Obviously, that's very critical in attracting capital to the sector and providing cash liquidity to these companies, which are investment intensive. And also, I think that really being in the right space for investors. Choosing the trust or portfolio manager with a good handle on what areas are attracting capital. We talked about what the exciting indications were as of late, but it's something that requires a lot of diligence and requires investors to pay a lot of attention. You have to know where the FDA is focused and try to guess and understand where M&A activity will be based on patent cliffs, based on needs in the market and where those spending dollars are going. As Wayne Gretzky said, and I'll go back. This is reflecting my Canadian roots here, but go to where the puck will be, not to where it is. So that's key in terms of identifying where the opportunities are.
Okay, and we've talked about the patent cliff. For large pharma, and so this is the understanding of this is that you've developed a drug, you're protected by a patent window, 15, 20 years, etc. That allows you to sort of command market share and premium pricing. As that comes off, you've got generics at lower prices coming in, and you've got your market share competed away. And that is going to ultimately impact your earnings as a large pharma. And so there is this sort of looming wall of dropping earnings, which they've got to replenish. So how do you think big pharma is sort of dealing with that in terms of the sector? Are they spending a little bit of time? Is it that they're building out their pipelines? Are they partnering with drug companies, etc.? How do you see that developing, Neil? Neil may have frozen. I'll come back to you. Hopefully Neil joins us in a second, and I will come back to that. But the other part of it, Milosz, maybe you can take this, which is that we talk a lot about M&A, and I mean, how much of a focus is that within the fund management groups, etc.? How richly do they consider it? How much does that play on their mind in terms of the sector's recovery and growth?
Let me put it this way. I think on one hand, it's an indication of the market sentiment and this is something we've seen not only within the biotech sector, but more broadly across the VC sector in recent years when we've seen the significant spike in interest rates. In many instances, those early stage companies don't have debt funding on their balance sheets. It doesn't impact them directly in terms of interest costs. Same for pre-commercial stage biotech, right? But what is important is that the base rate is the foundation for establishing the cost of capital, right? And what we've seen when interest rates have gone up significantly is that we moved to a different monetary policy regime, which meant that we had a disconnect between the buyers and sellers' expectations, and it was a bit difficult to price assets, to decide where the cost of capital should be. And this impacted deal activity significantly. And when you have a more limited deal activity, it also impacts the sentiment and the pricing of the broader market, right? So from that perspective, the M&A activity is very important, as is the activity in the IPO markets. And what we've seen recently, especially in 2023, right, we've seen a significant uptick in M&A once the estimate of the cost of capital in the market stabilized, right? Well, we've seen the indication that the rates are peaking and potentially we could see a turn in the interest rate cycle, and this encourages many of the big pharma companies to actually become more acquisitive. We've seen a number of these from Bristol Myers Squibb, from AbbVie, from AstraZeneca, etc. And this of course has an impact on the portfolios of healthcare-focused investment companies. some of them have parts of their portfolios which are specifically meant to target potential acquisition targets. For instance, the Worldwide Healthcare Trust has something they call an M&A swap basket, which is basically a derivative product designed by OrbiMed, by the investment manager, specifically aimed at focusing on those companies which are more likely acquisition targets. Whereas some other investment companies, they just tend to choose those companies which are good acquisition targets, right? And in some instances, this can have a quite significant impact on the performance. I think an example would be the RTW Biotech Opportunities Trust, where one of the largest holdings, Prometheus Biosciences, was acquired by Merck last year, and it had a visible positive contribution to their performance. I'll maybe let Neil comment on the patent cliff now and then.
Yeah, Neil, welcome back. Hopefully, the sound is going to be. I thought.
I hope so.
Opportune that as we talked about the patent cliff, you fell off.
Fell off that cliff. Yeah. And forgive me if I repeated anything that Milosz was talking about, but certainly patent cliffs are going to be a huge theme going forward. Of the 12 pharma drugs that we looked at with patent cliffs expiring from 2022 to 2029, they represented $150 billion in sales. I mean, that's a big gap to be filled. Upcoming patent cliffs on a wider selection of drugs represents over $200 billion in sales. It's a natural part of the cycle. You see this happen every 10 to 15 years. In the most recent time that we've seen these significant number of patent cliffs like this has been 2010. Bristol Myers Squibb, with the expiry of some major drugs, all blockbuster drugs, has acquired 3 biotech companies last year, with prices ranging in the hundreds of millions of dollars. AbbVie has also been very acquisitive after the loss of Humira, which is at one point the largest drug in the world. So they have a big hole to be filled as well. E&Y estimates that Big Pharma has approximately $1 trillion of spending resources. So M&A is expected to be a big driver of the biotech sector, given all these factors.
And is it? I mean, it's not just. Is the approach M&A, or do you see partnering, co-development, etc.? How do you? What are the typical ways that pharma will mitigate this?
I think it's all on the table. There's going to be a lot of risk sharing with early stage deals, but Big Pharma will go out. They'll use both their paper, their equity, and cash to acquire later stage drugs that have been substantially de-risked. And I'm not sure if Milosz had highlighted this, but the role of small biotechs is very critical in innovation. It's estimated that 55% of drugs approved by the FDA between 2011 and 2020 were developed by smaller biotechs. So I mean, that's historically speaking, and is very inefficient in R&D spending. With the cost of drugs representing the cost of one approved drug is now $3.5 billion, and that's because of all the failures in the phase 3 attrition that we've seen. So so Big Pharma is not good at it. Biotech is, and that's what's going to attract the dollars.
Okay. The other big thing that's been on people's mind over the certainly last couple of years, but it's been longer than that, is advancement in technology, and in particular things like AI and machine learning. How are you seeing that in terms of transforming the life sciences or healthcare sector?
I think it's going to be huge, but I don't think that we're going to see the real fruits of that in the near term. I see 4 key areas where AI is going to have a significant impact. Number one, the biology, which is understanding the cell processes. We've had this CASP competition where you've had some of the largest computing groups in the world competing to predict protein folding. And you've got the huge companies that are involved in that, Google and Oracle and whatnot. The second area is chemistry. which is predicting how different molecules, different configurations of molecules will bind to receptors, and eventually that's going to move into clinical trial design, determining looking at what has worked and what hasn't. Separate significant impact on medicine, using AI to diagnose and treat patient. What are the benefits? I think the benefits are clear. It's faster screening, eliminating the high costs and long timelines of trial and error in drug development. For clinical trials, learning from the mistakes that have already been made. I think that you'll see a lot of companies repeat mistakes that have happened in the past with other companies. And for medicine and diagnosis, obviously being more accurate and faster diagnosis. The challenge that you have is, number one, garbage in, garbage out, right? It's all about the inputs that are going to go into AI. I don't think we're there yet in terms of being able to assimilate and include all this information. Hallucinations that you're seeing from AI, where AI makes up things. There's a lot of things that need to be worked through, and of course integrating brand new technologies and things. But there are some companies that are very much focused on that, and I think that as the smaller biotechs start to integrate that into their early processes and eliminate the high cost of screening, that's when you're really going to see the benefits accrue.
Okay, thank you, Neil. And just a reminder, if anyone does want to pose a question to the analyst, please do put something into the Q&A. We're happy to try and field as many questions as we can. Milosz, I guess we've painted a scenario where there's a patent cliff. The farmer's going to be active in this. There's a war chest. There is M&A. There's interesting areas and technology developments in the sector. At the same time, I mean, when you hear Neil talk about protein folding, etc., it is a very specialist area, and which is why I think gaining exposure to it through the investment companies might be, an easier way of doing it. How do you when you're talking to investment companies, how do they mitigate risk while recognizing effectively the opportunity within the sector?
Yes, I think it's a very important point, because as we know, the investment case for many biotechs is quite binary around specific events, most notably the clinical trial results, right? And it's quite often difficult especially for a generous investor, but sometimes also for a specialist investor, to actually pick the winner in a given therapeutic area, right? So there are a couple of ways investment companies can mitigate risk. I will start from the basics. So firstly, the sector expertise, right? So very often fund manager and the team behind the fund manager has a very strong understanding of the science behind those companies, right? So it includes people with medical degree, former CEOs of healthcare companies, right? And this helps mitigate risk by eliminating some of the companies which are maybe less promising in terms of their development. So that's the first thing. Secondly, the investment companies we discussed are closed-end funds, which is also important from the perspective of the cyclicality of the sector. So they are not at the mercy of inflows and redemptions, which, as we know, the inflows tend to peak when prices are close to the peak, and the other way around, right? So the fact that they actually are a closed-end fund, and they can freely decide how much cash they want to keep at any given stage of the cycle to pursue opportunities when they are priced more attractively. That's very important. An obvious thing is, of course, portfolio diversification. I've mentioned that they often pursue a kind of a high conviction portfolio approach, but it still means that many of them will have a fairly diversified portfolio, right? And even if they face a failure in one of the companies, it will not have a dramatic impact on the performance of the investment company as a whole. So this is worth noting. Some of those investment companies also take a basket approach to gaining exposure to certain therapeutic areas, especially those which are highly contested and where it's difficult to actually pick the winner, right? So they will prefer to hold a few companies with exposure to a given therapeutic area with the intention to then benefit from from the positive development of a subset of those companies, right? So this also helps mitigate risk. Some of them can move across the market cap spectrum, as I already mentioned. So if they are proficient in terms of timing the market, which is not always easy, but some of them I think have shown that they are good at it. They can move more into the larger mega cap spectrum, the more cash generative businesses when things are getting tougher, and then rotate into smaller and emerging biotech companies when they see better opportunities with this respect. And actually what we've seen when analyzing the investment companies, which are more flexible in this respect, is that they now tend to have their portfolios tilted to the smaller emerging biotech space, which seems to resonate well with the main thesis of our thematic piece. What's interesting, some of those companies also tend to adjust their exposure to individual holdings or even sell those down ahead of major binary events like clinical trial results, actually to in order not to have the exposure to the volatility associated with those events, which I found quite interesting. And especially when talking about those biotechs which are pre-commercial stage, which are yet to break even if they already got a drug approved. A very important point is a focus on the cash runway of those businesses, which is important across the VC sector, including the biotechs, right? So this is also something they closely monitor, and which also helps them mitigate risk to understand if a given company has enough cash runway, right? Or what's the funding syndicate behind this company, how likely it is to actually be able to secure funding until a major milestone, right? And this is important because when we look at valuations across the biotech sector, a quite frequently used measure is the market cap, or EV to net cash, right? And the fact that a quite significant proportion of biotech companies were traded below net cash. For those participants on the webinar who watched the ShareSoc event with the Biotech Growth Trusts, they may remember the kind of a chart showing that actually spiked the proportion of biotechs trading below net cash spiked at around 25%, and it's still ahead of long-term average. But it doesn't help you much if a company is traded below net cash if it doesn't have the cash runway to actually achieve its milestones, right? Because then it goes bust and it doesn't help much, right? So this is also an important focus area. And then finally, of course, structuring the portfolio in a way which creates a good balance between commercial stage and pre-commercial stage businesses, or when they're pre-commercial stage, focusing on the most promising businesses.
Okay, and I've got one follow-up, and then I'm just going to take a couple of questions that have sort of come up. So you talked about this sort of portfolio approach of particularly in sort of areas where you couldn't necessarily pick the winner, you take a basket approach. What are you seeing where there's clearly areas where people want exposure, so obesity and Novo Nordisk and things like that? What are you seeing in terms of exposure to those innovative or hot therapy areas?
Yes, I think it's broadly in line with what Neil discussed. So the healthcare focused investment companies within their biotech exposure, right? They often have quite significant weighting into oncology. Central nervous system is a very important area for them. Immunology, inflammation, but also rare diseases. I would note, and then of course obesity, either through the large Eli Lilly and Novo Nordisk, or in some instances through promising contenders, right? Because some of the drugs being currently developed aim at higher efficiency, minimizing side effects like nausea, etc., and also providing an optimal dosing and administration, right? So some of the investment companies also look at earlier stage companies, which sometimes raise quite significant funds in early stage rounds to address those those issues.
Okay, perfect. Listen, let me switch over to just because we're here to answer questions. So I just want to switch to a couple of questions that have come in. One of them is how important is gaining FDA approval to the share price of small and mid-cap biotechs when positive and when negative. And let's break this down in terms of steps, right? So you're typically going through a regulatory approval process. You have a phase 1, phase 2, phase 3 type approach effectively of these trials happening. And this is the various steps that a biotech company has to take to get a drug to approval. The typical probability rates of success at those points is that my understanding is, and correct me if I'm wrong, so at typically 90% of phase 1s don't quite get through, etc., because it's such a big spread of let's try this out. Phase 2s, you're probably looking at sort of 30 to 40%, and then phase 3, 60 to 70%. Is that it? So when you're looking at the end prize, which is you get this drug approved, you're going to get this market is worth 100 billion, you're going to get 25% market share of this at this particular price, and there's, of course, there's marketing costs and launch costs and production costs against that. That's the way I would envisage sort of modeling it, and that those stepped crystallization points, if you get through the phase 1, you're now into a much higher probability of that happening. Is that a fair way of looking at the impact of FDA and the impact you see on the share prices of small and mid cap biotechs?
Yeah, yes, for sure. I mean, when you're looking at one drug, a discrete drug, you're going to be looking at different decision nodes along the way.
Yeah.
A lot of times the earlier decisions are not in the hands of the FDA. It's the company really that's going to look at it and say, can I move forward with this or not? Of course, the FDA is going to have a say in it and look at the data and say, okay, we're going to let you move to the next stage or not.
Yeah.
But you're very close in terms of the likelihood of success. I would actually say probably the phase 3s are a bit lower. But ultimately you're looking at less than 10% of phase 1 drugs that ultimately make it through this entire process. When you're looking at just the FDA approval at the end, obviously it's very critical. But I mean, I've been watching this sector for almost 20 years, and I would say that in the context of your comments, it's not necessarily the approval that you want to sit and wait for as an investor. I've been surprised both ways. There's drugs that I thought for sure the FDA would approve, and for whatever reason they don't outright reject it, but they'll certainly their concerns, and then that can be a long, arduous, and expensive process for the company. And then on the other side of the coin, there's ones that you kind of thought, well, I wasn't too excited about that data, but nonetheless, the FDA says, okay, this is an unmet medical need, and we'll approve it. You don't necessarily want to be sitting and waiting for that. It's about the escalator ride up, and understanding where valuations sit and where what the market assessment is of the risk for those drugs, and to make a decision of whether you're buying and selling, which really kind of suggests that you should put that in the hands of a portfolio manager who has a lot of experience and the ability to diversify your risk through exposure to multiple different companies.
Okay, thank you, Neil. And then Milosz, maybe a question for you, which is, what do you think the biggest risks are to the investment company sector?
Yeah, that's a good question. I mean, some of those risks are just basically associated with the nature of investments in biotech companies, and the more concentrated the portfolio, obviously, the greater impact of individual stocks, right? So when you look at our report, you see that there are some trusts which have a greater portfolio concentration. In some instances, they have 10 or 15 names in the portfolio, which of course means that they are very much dependent on the success of the individual companies. Those investment companies which are largely skewed to private investments, I think one thing worth keeping in mind is that as some of your holdings progress to the later phases of clinical trials, right, your portfolio may become quite skewed towards those businesses, right? So if it becomes a large part of your portfolio, right, and you suddenly have a very large holding with a phase 3 clinical trial which fails, of course, this will have a great impact on your portfolio, right? And it may be slightly more difficult to manage this this portfolio composition if you have a large part of your portfolio in private investments, right? Then secondly, I think what probably was also a bit of a risk across the VC sector is that when the deal activity became much more muted, right? This meant that raising new funding has become more difficult, extending cash runways has become more difficult, and the opportunity to exit those assets as well, right? On top of this, with such a significant change in the interest rate regime, I think some investors may have been more cautious in terms of private asset valuations. I will not go into the detail to what extent this was warranted, right? In all of those cases, because it's a completely different conversation, right? But in those instances, some of those investment companies which have a high share of private investments, they've seen that discounts widening much, I mean, to greater extent than maybe some of the peers which focus on listed holdings, right? This would be one thing. And the question how to support the portfolio, how to select those companies which we want to support further versus those which we give up on probably would be another important point to discuss. And then, well, probably always worth mention the gearing, right? Because investment companies usually have a policy where they can gear up a little bit. It's not maybe very significant. It's usually not more than 20%, and most of the companies don't actually use the maximum limit, right? But of course, this may add to the volatility of performance if the timing of increasing or reducing gearing is suboptimal, I would say.
Okay, and then one final follow-up to that, because we always look for margin of safety in all of these things, and I think it's worth looking at. There's the underlying asset value, but then there's the discount to that asset value, the discount to NAV. And I just wanted you to sort of give me a view on, what are you seeing in terms of the discount to NAV? How wide is it compared to history, etc.? And what is that telling you about the sector?
Yeah, so as I mentioned before, we've seen a widening of the discounts to some extent, but when we looked closer at it, it turns out that they are maybe not very extreme. It's not like they are well in excess of the range we've seen over the last 10 years. Having said that, if you look at the sector in aggregate, then you see a quite significant skew to the downside in terms of the discounts, right? So in a sense, you can say that that the sector as a whole, in terms of discount now, NAV looks, let's say, maybe more attractively priced, if I can use this expression. Obviously, in some instances, those wider discounts have some particular reasons, right? But you get this, and on top of this, you get the portfolio of biotech companies, which are on average also priced at probably undemanding levels, right? So this is probably worth keeping in mind. Now, of course, as with other investment companies, a wider discount also raises the question whether it makes actually sense to pursue new investments or maybe a larger buyback program, right? And some of the investment companies have certain discount control mechanisms in place, which even if they are not fully successful in reducing the discount to NAV, in some instances they contribute to a reduction in the discount volatility, which helps. And then some of the investment companies also tie the level of realization proceeds to, so they earmark a percentage of their realization proceeds to buybacks in case the discount to NAV exceeds a certain threshold, right? So this provides a kind of a well-defined mechanism. But here it's also important to set the threshold at the right level, because I've seen examples where the threshold was set too tight, and this actually limited the investment company's ability to make new investments, right? And then they decided to slightly change relax the discount control mechanism to actually be able to benefit from the opportunities in the market, right?
Yeah, thank you, Milosz. And I'm conscious we're coming up pretty close to the hour mark, so I'm going to try and just wrap up here. I mean, the healthcare sector, what I've heard is that the healthcare sector clearly is in an attractive place to look at. It's been through its ups and its downs, but the environment looks interesting, both from where big pharma is standing and the ability to put money into the sector, but also just in terms of the crystallization of value and the regulatory approval process and these sort of new innovative technologies and drugs coming through. A lot of that being supported through biotech in particular, which has been successful in developing these new drugs. Playing individual stocks clearly is risky in the sector, and I guess you need to know what you're doing and have an understanding of the science to be able to understand, whether you're better or worse than the street in terms of calling an outcome. Which is why I think the investment company sector is an interesting place to get exposure to that. And you've described the different approaches, concentrated versus sort of diversified portfolios, exposed to listed and unlisted companies which have got mechanisms to protect in terms of discount to NAV, etc. And so would love people to follow up, and if they've got any specific questions once they've read the report, would encourage you to drop us an email. Happy to field any questions. Thank you, Milosz, and thank you, Neil, for participating in this. I hope that the members of ShareSoc have found it useful. It was our first one. Please do feedback to Mike and his team if there's anything you'd like to see changed or iterated for future ones that we do.